Welcome to Investors Insights. Our topic today is weather, containers, and markets. I'm joined by my distinguished colleagues, Trey Booth, Bobby Norman, and Ty Miller, and we just finished a great portfolio strategies meeting. We're very excited about the information we're going to present today, and hopefully you will hear details and insight that you're not hearing from any other source. So starting off, Trey, you had my full attention here when you started talking about weather and containers. Great research on your part and the rippling effect of how these things can impact the rest of the economy. Share this with our viewers.
Yeah, absolutely. Thanks, Greg. So these two events have heightened importance this week because the Federal Reserve is meeting, and that has been a must-watch event every few months when they get together because the Fed is watching inflation. And after the last meeting back in November, the market started pricing in 6 rate cuts based on the Fed's optimistic outlook on inflation. While we've talked since then on these vlogs multiple times about how we don't believe that is likely to occur, this will be the first time that the Fed will come together and push out what they believe is the expectations for this year. And there were 2 instances recently that we feel like the Fed will likely have to look at in terms of the impact it might have on inflation, and then because of inflation, the impact it'll have on interest rates. And that is the weather. The last few weeks, I think we've all noticed it's a little chillier here in Alabama, but that really doesn't impact oil production. Where it impacts it is in North Dakota, where we produce a lot of oil. It was so cold that they had to stop producing oil. Normally, weather-related oil production cuts have to do with hurricanes going through the Gulf. But this was a cold spike. So this is a first in a long time. And that's largely because of our production increase in parts of the country that get dangerously cold. And so oil production in North Dakota actually dropped by 1 million barrels a day for the week ending January 19th. That is a lot of oil coming off the market. You can see in this chart that spike down in oil on the far right only mimics due to hurricanes back in 2021. So this is something that hasn't quite yet bled into the gas market, but will take some time. And eventually, you see that large amount of production cut, you really don't get that back. Because when you start up, you just get back to normal. And so we expect that may have an inflationary impact down the road in oil. In addition to that, something that Ty's been talking about on these on our vlogs is the impact of the Red Sea and the Middle East conflict on shipping. And that continues to get worse and worse. The Friday data that I'm showing on this chart right now shows that parts of the shipping lanes are now 225% higher in terms of cost than they were just 4 weeks ago. Now, we all remember shipping in 2021 that it seemed like something that the Fed called transitory, but it turned out to be much worse than transitory. So I would be surprised if the Fed used that word this time. And I would expect them to be more cautious in blowing off what appears to be these one-off situations that we expect will cause prices to go higher in the near term. And it'd be hard for the Fed to project strong rate cuts and inflation being beaten when we see these cost inputs coming in quickly right into their meetings. So something we're watching closely, and we feel like the Fed's definitely going to be watching.
Again, Trey, I thought that was great insight. You know, throughout my career, there's been times weather and containers have been issues that it started out that way and then caused a huge rippling effect. And it's something that we watch here at Five Plan Partners and lets our clients know the depth we go to see where that rippling effect takes place. Too often we've had clients say, how did all this start? And we like to know how it starts so we can look at the trends and what direction we need to go in navigating the markets. And then, Bobby, you came forward with great data on the U.S., how we're looking. You know, yes, we have these issues like weather and containers going on, but in relation to the U.S. market, talk about that because your information I really enjoyed.
Yeah, something we like to do in our vlogs is cover topics that clients and business partners ask us about throughout the previous week. And one topic that came up in a discussion last week was why in most of our strategies, our investment strategies, are we heavily overweight the U.S. stock market compared to international markets. So looking at this first chart that shows annual global equity returns going back to 2011, the U.S. markets have enjoyed fairly consistent outperformance. And you can see the U.S. markets in the orange columns and the rest of the world markets in the gray columns. And we have been overweight U.S. markets throughout this time period, going back to 2011. But looking forward, we are focused on where economic growth is expected to be favorable. And looking at this next chart showing consensus global GDP expectations, the expectations are favoring the U.S., which can be seen on the far right column as growth expectations are increasing in the U.S., which is the only economy globally trending higher. So fundamentals for 2024 clearly favor the U.S. Not saying that international exposure doesn't make sense, because it does offer some diversification, but the U.S. economy and the markets look to continue its outperformance, especially in the near term.
Yeah, great explanation. It's why we go in that direction, and we'll continue to stay there so long as we continue to get this kind of data. So, Bobby, thank you for that research. And Ty, you then came forward and just said, okay, yeah, U.S. market's looking good, U.S. economy, but we also need to always keep our eye on every detail. And one of those details is long-term debt. And so elaborate on that.
To Trey's point, the Fed is meeting this week. It's a big meeting to see what they do with interest rates. But there's another meeting this week that maybe isn't getting the notoriety as the Fed meeting, and that's the Treasury quarterly refunding meeting. And so this meeting has a big impact on markets, as you can see in this chart. Back in August, the Treasury made a decision to issue more long-term debt for the first time in 3 years. And as you can see in the blue bars, that had a big impact on the market negatively. At the same time, yields rose and the dollar spiked. And so in November, they kind of reversed course and started to issue more short-term debt. And that had a polar opposite effect on the market at the time. You can see that the stock market soared, dollar was down, yields went down. And so that's, kind of what we're looking at here. Well, they have another meeting coming up this week. And so it's going to be important to see, do they kind of go the short-term route or the long-term route? Yields are in a different spot than they were at the end of last year. And it's going to be interesting to see how the markets kind of digest what they decide.
Yeah, it's something we're going to watch closely, very much so. So, folks, we hope this is information you're not hearing from anyone else. In fact, last week I had a client tell me that he loves to take topics from our blog, and when he goes to social events, he brings them up, and people are like, "Where'd you hear that from?" And he said, "I got a blog, I'll send you." And so we appreciate all of you that are sending to people our information, sharing it with you, with your family members, neighbors, colleagues. It means a lot to us. In addition to that, this kind of information we continue throughout the week on our social media, LinkedIn and Twitter, Facebook, YouTube, our podcast. We're going to continue delivering information. As I like to say, we're frustrated educators at times, and we want you to know what's going on. We thank you for believing in us, those of you that have your money with us. It means so much. Don't hesitate to call us, send us an email, and we look forward to future discussions. Take care. Have a great week.